Ray, I've watched this movie play out so many times it feels like Groundhog Day for investors. Late 90s internet mania, remember pets.com and Webvan? 2006 housing bubble where everyone thought home prices only go up? Crypto madness in 2021 with Bitcoin at 69,000 and people taking out loans to buy digital cats. Now it's AI's turn. Every single decade, the market falls head over heels for a shiny new story. People stop asking the basic question, what's this business actually worth based on the cash it spits out? And start chasing the siren song of how much higher can it go before I'm the last fool standing at the party. Look at the numbers right now. AI stocks, NVIDIA, Microsoft, the whole Magnificent Seven crew have added $19 trillion of market value since ChatGPT dropped in late 2022. That's according to Goldman Sachs' latest report. But here's the kicker. Goldman says the stock market has already priced in most, if not all, of the optimistic economic impact from AI. NVIDIA trades at 70 times forward earnings. Some smaller AI plays don't even have earnings. They're trading on pure hope and hype. Microsoft's latest quarter showed AI revenue growth slowing from triple digits to the high double digits. I see genuinely impressive technology that could transform industries. But I also see valuations that assume flawless execution, zero competition, perfect margins, and AI adoption sweeping across the entire global economy without a single hitch. Great technology has never been the same thing as a great investment when you pay an arm, a leg, and your firstborn child for the privilege. And right now, the price of admission to this AI party looks steeper than the Eiffel Tower.
Warren, you're spot on that many of these leading AI names look dangerously stretched when you stack their current cash flows against those nosebleed valuations. From the perspective of my systematic bubble framework, which I've refined over decades, studying every mania from tulip bulbs to dot-coms to crypto, this situation checks every single box of classic late-stage bubble territory. We've got explosive recent returns that have crushed every other asset class. We've got a genuinely transformative narrative about AI rewriting the rules of every industry, from healthcare to finance to manufacturing. We've got extreme concentration. 7 mega-cap names now account for 35% of the entire S&P 500's market cap, the highest concentration since the Nifty 50 debacle in the early 70s. And we've got investors extrapolating 3 years of manic growth into infinity, completely ignoring mean reversion. I said publicly just last month that we're 70 to 80% of the way into a full-blown AI bubble. And I used NVIDIA as the poster child because its valuation embeds assumptions that would make even the most bullish analyst blush. History doesn't lie. Whenever you see this exact combination of factors align, the next decade's actual returns from those hottest of the hot assets come in dramatically lower than what the prices imply. But, and this is crucial, simply spotting that you're in bubble territory and knowing precisely when or how that bubble will deflate are two completely different beasts. Bubbles have a nasty habit of running much longer and climbing much higher than any rational observer thinks possible. I've seen investors who were dead right about valuations get shaken out early, only to watch the final parabolic leg play out while they sit on the sidelines kicking themselves. The psychology of manias is powerful. FOMO doesn't care about discounted cash flow models.
That's precisely why I've never wasted a single minute playing the fool's game of when does it pop? I don't need a crystal ball to tell me if the bubble bursts in 6 months, 6 years, or whether it deflates slowly like a sad balloon over a decade. What I absolutely need, and what I can determine with high confidence, is whether today's price gives me a genuine margin of safety based on conservative, realistic estimates of the cash flows this business will actually produce over the next 10, 20, even 50 years. With most of these AI leaders, I simply cannot do that math and sleep comfortably at night. The sales pitch has shifted from boring old earnings and unit economics to exotic concepts like total addressable market, embedded option value, winner takes most network effects. I've heard that exact same song and dance before, in 1999, when every dot-com company with a website and no profits traded at bigger market caps than Coca-Cola, which had been printing cash for decades. The Nasdaq peaked, then fell 78% from peak to trough. Most of those companies disappeared into the dustbin of history. Even the survivors like Amazon and Cisco got cut in half, some by 90%, before the slow multi-year recovery. I didn't need to predict the exact day the music stopped playing. I just needed the discipline to refuse buying into the hype at peak mania prices. That same timeless principle applies perfectly to today's AI frenzy. Show me the durable cash flows first, then we'll talk price. Until then, I'm happy watching from the sidelines with my $347 billion in dry powder.
And right there, you hit the nail on the head about the fundamental philosophical divergence between how you and I approach uncertainty, Warren. Your response is to eliminate it entirely by only touching individual businesses you can value with near certainty, classic value investing discipline. My response is to accept that uncertainty is simply a feature of complex systems, not a bug, and manage it systematically through diversification, strict risk controls, and deep understanding of where we sit in the broader multi-year cycle. Every single major bubble I've ever studied, from the South Sea bubble in 1720 to Japan in the late 80s to tech in 2000, follows the same predictable two-phase pattern. Phase 1, the story plus liquidity euphoria phase, where easy money from near-zero rates combines with a compelling narrative to drive prices to levels that make fundamental analysts weep. That's exactly where we sit today with AI, deep into Phase 1. Phase 2, the need for cash reality phase. Something inevitably changes. Financing costs rise because rates refuse to go back to zero. Economic growth slows below expectations. Credit conditions tighten unexpectedly, or investors collectively decide they want their money back to fund other opportunities. It's that sudden, desperate pressure to raise cash that actually pricks the bubble, not the mere fact that prices got high in the first place. Right now, in 2025, we're seeing the first cracks of that Phase 2 transition. AI capital expenditures hit $400 billion globally this year alone, But return on investment questions are starting to emerge loudly. Microsoft's latest earnings showed AI revenue growth decelerating. Enterprise customers who rushed to buy AI capacity in 2023 and 2024 are now demanding proof of tangible productivity gains before signing the next multi-year contract. That's the shift from buy everything AI to show me the money beginning. But we could easily see one more blow-off top leg higher before reality fully sets in.
You're describing with textbook precision the monetary environment we've all lived through since rates bottomed out near zero post-2020. When money feels essentially free, suddenly every marginal project, every moonshot idea looks like a can't-miss opportunity. Future profits that should compound over decades get pulled forward into today's valuations through a simple twist of the discount rate dial. Then reality arrives with the bill. What troubles me most about the current AI leaders isn't the technology itself. AI absolutely could transform white-collar work the way electricity transformed manufacturing. What troubles me is they're priced as if they'll flawlessly convert today's excitement into durable, high-margin cash flows that capture 30% plus of global GDP growth forever, with no meaningful competitive response, no regulatory pushback, no execution hiccups. That's not prudent investing. That's wild extrapolation dressed up in sophisticated jargon. Railroads physically transformed America in the 19th century, knitting together a continent for the first time. But most railroad stocks went spectacularly bust because investors overpaid for the privilege of participating in the revolution. The internet created trillions in aggregate value. But Pets.com burning through cash delivering dog food went to zero. Webvan collapsed, and even survivors like Amazon fell 90% from peak before the decade-long recovery. Some AI winners will absolutely emerge and compound beautifully for decades. But making concentrated bets on the current batch of leaders at current prices completely ignores the brutal realities of competition, regulation, technological leapfrogging, and plain execution risk. When you set the expectations bar stratospheric, even genuinely good quarterly results can trigger massive disappointment if they miss the whisper number by a few percentage points.
You make an absolutely critical distinction there, Warren, one that far too many investors miss. A technology can prove completely transformative at the societal level, while still delivering terrible shareholder returns if you buy into the mania at the wrong price and the wrong time. This entire AI boom isn't happening in a vacuum. It's riding on top of an already unprecedented decade-long expansion of virtually all asset prices fueled by the lowest rates in 400 years of recorded history and multiple rounds of quantitative easing that made money feel like confetti. We've piled several $1 trillion of incremental market value onto a relatively narrow group of AI-exposed megacaps. Goldman Sachs research estimates the equity market may have already discounted somewhere between $15 and $19 trillion of AI's maximum plausible economic impact over the next 20 years, essentially front-running 2 decades of benefits into today's prices. That doesn't mean AI technology itself fails or under-delivers on productivity transformation. it likely delivers big. But it does mean forward investment returns get mathematically compressed, sometimes severely. Late-cycle bubbles like this always shift from pure narrative-driven rally mode to brutal show-me-the-money reality mode. Customers who bought the AI hype hook, line, and sinker now want proven return on investment before paying hyperscaler premium prices for the next wave of capacity. Enterprises that loaded up on AI infrastructure in 2023 and 2024 are scrutinizing every dollar of productivity gain. That mindset shift creates massive volatility and extreme selectivity. The true long-term winners will consolidate power, but the path between here and there gets exceptionally rocky with plenty of casualties along the way.
Show me the money captures the inevitable psychology shift perfectly, Ray. Investors can live on compelling stories and PowerPoint visions for only so long before they tire and demand actual cash flowing to the bottom line. The beauty of my approach? The wonderful businesses I own already print that cash predictably at reasonable multiples of 15 to 20 times earnings. No miracles, no flawless execution, no heroic growth assumptions required to make the math work beautifully over decades. AI champions trading at 40, 50, 70 times forward earnings, or with no earnings at all, embed flawless linear growth forever with expanding margins in every single market they enter. Markets never behave linearly, period. Competitors always respond aggressively. Regulators circle like vultures when dominance appears excessive. Execution almost always stumbles on scaling hurdles or talent shortages or unexpected technical roadblocks. When you set the expectations bar sky high into the stratosphere, even solid beat and raise quarterly earnings miss the whisper number by a few basis points, and suddenly the stock tanks 20% overnight. I'd sleep much better owning a boring but consistently profitable railroad, steadily moving freight and generating 10% returns on capital, than a glamorous AI story that's priced for absolute perfection across every dimension for the next decade. History sides with the boring compounders every single time. They outlast the shooting stars.
You're nailing what I call expectations risk, the single most dangerous hallmark of any late-stage bubble. As euphoria peaks, the bar for positive surprises climbs higher and higher until it becomes mathematically impossible to clear. From my recent public comments, I'd peg us at 70 to 80% through the classic bubble pattern. Current valuations embed relentless breakneck adoption across every industry, sustained or expanding high margins despite commoditizing infrastructure, and continued dominance by today's clear leaders with no meaningful competitive disruption. But early fundamental cracks are showing everywhere you look. Enterprises dramatically slowing AI spending after the initial 2023-2024 hype cycle. NVIDIA's growth now needing to accelerate from an absolutely massive revenue base while facing real competition from custom chips by hyperscalers. Early questions about whether AI delivers genuine 10% plus productivity gains or just incremental 5% improvements. Any sustained growth deceleration, margin compression, or competitive upset triggers immediate and brutal repricing. This marks the critical transition from narrative-driven parabolic gains to fundamentals-driven high volatility and extreme selectivity. The inevitable shakeout brutally favors the true long-term survivors while crushing the speculators and overpayers.
And that's exactly why chasing whatever's most popular always feels most dangerous to me, Ray. I've said it 1,000 times. You don't have to swing at every single pitch life throws at you. There are no called strikes in investing, unlike baseball. Right now, the AI pitch being relentlessly thrown at every investor with a pulse is undeniably glamorous. Trillion-dollar total addressable market headlines. Entire industries about to get completely rewritten. This changes everything, TED Talk visions. But if I cannot underwrite those massive TAM numbers with a deeply conservative model that still works beautifully, even if execution proves merely good instead of flawlessly perfect, I walk away. Better to own a genuinely good business at a fair price than the greatest story ever told at a price that assumes literally everything goes exactly right for the next 10 to 20 years straight. Remember the Nifty 50 in the early 70s? IBM, Xerox, Polaroid, all must-own forever growth names, trading at 50 times earnings when the market average traded at 15. The one-decision stocks. They fell 65% on average. Same exact script, different labels and era. Valuation discipline and patience always beat FOMO and crowd euphoria every time in the history books.
From a pure cycle perspective, I'd frame it slightly differently. You don't need to perfectly predict or surf every single wave in the ocean. You just need to position yourself so you don't get completely wiped out when the big rogue one inevitably breaks. In my recent discussions and interviews, I've been crystal clear that we are definitely, without question, in a bubble in certain key AI-related assets and themes. But that recognition doesn't automatically translate to sell everything immediately and run for the hills. The real mortal danger lurks for investors who make highly concentrated bets on one-way outcome scenarios. Higher for longer interest rates than the AI bulls priced in? Earnings growth that merely meets expectations instead of crushing them? Any whiff of competitive disruption? Those overpriced names can crater 50 to 80% in weeks. But if you're properly diversified across sectors, regions, asset classes, and you size your AI exposure in line with its genuine risk profile, rather than treating it like a risk-free call option on the future, then one sector-specific bubble bursting somewhere else in the market simply doesn't have the power to destroy your entire financial future. AI absolutely remains a genuine decade-plus megatrend with transformative power. The intelligent question isn't binary yes or no to AI. It's how much exposure, in what specific form, at what sizing, relative to the risks.
So, when regular investors corner me and ask point blank, Warren, AI bubble, is it time to sell before it bursts? My answer stays simple. even if they don't like hearing it. First question right back at 'em. What exactly do you own right now, and why did you buy it in the first place? If the honest answer sounds anything like, well, it doubled last year and my buddy on the trading desk said it's going to the moon, then yes, I'd be thinking very seriously about stepping back to the sidelines. Not because I can magically time the exact top to the day. Nobody can consistently do that. But because that entire thought process reveals you're not investing, you're purely speculating on momentum. Doesn't matter whether the label reads AI, housing, tulips, or beanie babies. The right question isn't, will it go a bit higher short term? The right question is, if this entire position dropped 50% or 70% tomorrow morning, would I still feel completely comfortable owning it at that level? If your gut answer is a panicked no, that might be all the signal you need. You don't need a sophisticated forecast about the precise bubble top to recognize when you've tied your entire financial future to a momentum story rather than durable, predictable economics.
I'd add an important nuance to that excellent stress test, Warren. From both a macro and historical pattern recognition standpoint, bubbles consistently go much further and last much longer than any rational valuation model or fundamental observer thinks humanly possible. If you sell purely because something looks expensive on paper, you may well be proven fundamentally correct about the overvaluation while being spectacularly early on price action, sometimes by years. That's precisely why my recent advice has emphasized this balance. Don't let legitimate fear of an emerging bubble push you entirely out of structural multi-decade trends like artificial intelligence. But also don't let greed tie you exclusively and heavily to the single most crowded, most expensive, most consensus-driven ways of expressing that theme right now. Plenty of safer, more diversified avenues exist to benefit from a genuine technology wave. Think suppliers of critical infrastructure, power generation and transmission for AI data centers, broad technology indices, even international AI exposure outside the U.S. megacaps. Those vehicles let you participate in the upside while materially reducing the tail risk of getting caught holding the hottest, priciest names when the cycle inevitably turns. Proper cycle timing beats perfect timing, but intelligent positioning survives even mistimed entries.
You're essentially reframing the entire question away from the binary trap of AI, yes or no, to the far more intelligent, how much exposure makes sense, and in precisely what form. I'd completely agree with that smarter framing. For the vast majority of individual investors without godlike stock-picking ability, owning a broadly diversified index that happens to include meaningful AI beneficiaries represents a dramatically different proposition from betting half your net worth on one or two highly valued single AI names you heard hyped on CNBC or some trading podcast. The index approach humbly acknowledges that the future remains deeply uncertain, that you cannot possibly know with certainty which specific company or narrow group emerges as the decade-long winner. The concentrated single-name bet represents a vote of supreme confidence, not just in the underlying technology trend, but in your own personal ability to outguess millions of other professional and institutional participants about exactly which company dominates, precisely when that domination arrives, and, crucially, at what price that future domination proves worth buying today. That's an extraordinarily tall order with terrible odds that rarely ends well for the amateur.
Spot on, Warren. When I systematically study past genuine technological transformations, railroads stitching America together, electricity lighting up factories and homes, automobiles killing horses and creating suburbs, the internet creating entirely new industries, the pattern emerges crystal clear. Broad technology adoption creates enormous aggregate economic value, but that value gets distributed highly unevenly across individual companies and unevenly across time. Many supposed early leaders completely vanished. Others delivered genuinely decent products and services, but generated poor shareholder returns because investors wildly overpaid during the peak mania phase. A small, privileged subset produced the extraordinary long-term compounding gains. From a cycle standpoint, that's precisely why I focus far less energy on trying to identify and bet heavily on the next decade's champion, and far more on rigorously understanding the surrounding environment, prevailing credit conditions, likely policy responses, shifting investor sentiment and positioning, geopolitical wildcards. Those macro forces determine whether a promising technology theme morphs into a full-blown bubble, then an excruciating bust, or a more orderly growth trajectory. Understand and respect those forces first, then position your portfolio accordingly.
And when that inevitable bust phase arrives, which it always does, it tends to brutally expose exactly who was swimming naked all along, to borrow the phrase I've used before. Easy money environments like the past decade hide all manner of sins. In a world where capital flows like water and investors prove endlessly forgiving of red ink, even mediocre businesses with shaky economics can raise endless funds and tell increasingly elaborate stories about the glorious future. Tighten those conditions even moderately, and harsh reality reasserts itself with a vengeance. Companies that never demonstrated a clear path to sustainable profitability suddenly find the door to new rounds of financing slammed shut. Investors who thought they owned the future discover they actually owned a fragile collection of weak balance sheets, sky-high burn rates, and wildly over-optimistic promises that no longer pass muster. That's precisely when people rediscover, often painfully, that valuation discipline and business quality matter far more than visionary TED Talks or hockey stick PowerPoint projections. The AI hype will inevitably fade, but the cash generators with genuine pricing power endure through every cycle.
From the macro cycle perspective, that bust moment typically coincides exactly with what I term the deleveraging phase across the system. Households, corporations, even governments collectively realize that all the debt and embedded risk they comfortably accumulated during the preceding boom years has suddenly become utterly unsustainable under the new regime. Higher rates, slower growth than promised, shifting policy winds, or simple risk aversion. Everyone responds simultaneously by slashing spending, selling whatever assets they can liquidate, and desperately deleveraging balance sheets. That process can unfold orderly if policymakers act preemptively and markets cooperate, or catastrophically disorderly if everyone panics at once. Right now, in late 2025, a real risk exists that if the AI bubble unwinds simultaneously with other systemic vulnerabilities, sky-high public sector debt loads, stretched private credit markets, geopolitical wildcards, it creates a perfect storm amplifying the entire downturn. That's precisely why I stress preparation over prediction. Build liquidity buffers ahead of time. Diversify thoughtfully across uncorrelated return streams. Set realistic return expectations rather than chasing bubble unicorns.
People also chronically underestimate how their own human psychology operates in these high-stakes moments. It's dead simple to preach, "Be greedy when others are fearful," from the safety of calm bull markets, proving far harder to actually hold your nerve when the headlines flip overnight from "AI will change everything forever" to "trillions wiped out in historic tech rout." If you built your position primarily on excitement, social proof, and momentum rather than deep business understanding, fear drives exactly the wrong decisions at exactly the wrong moment. My entire approach centers on making investment decisions today that I'd feel completely comfortable with, even if tomorrow's Wall Street Journal headlines prove brutally unpleasant. That usually means owning businesses I'd happily add to aggressively if prices fell sharply, rather than names I secretly pray won't drop because I'd panic and sell into the bottom.
That psychological insight connects directly to how I design risk parity and all-weather portfolios that simply don't rely on any single narrative proving correct. If AI delivers the most wildly optimistic projections and transforms global productivity, diversified investors still meaningfully benefit through broad equity exposure, corporate profit margins expanding, economic growth acceleration. If the AI bubble bursts spectacularly and drags down that narrow group of overpriced leaders, they simply won't get ruined because their risk got spread thoughtfully across assets that respond differently to various economic shocks. Bonds for deflationary busts, inflation hedges for currency debasement, non-US markets and commodities for diversification. The investors who get absolutely crushed worst in these violent cycles rarely prove those who owned some AI exposure. They prove those who owned almost nothing else, fully concentrated in the single hottest story du jour.
So, If that regular, everyday investor walks up tomorrow and asks directly, Warren, facing this AI bubble, is it time to sell before it bursts? My first question fires right back. Tell me exactly what you own right now, and more importantly, why did you buy it? If the honest answer sounds anything like, well, it doubled 3 times last year, and my friend on the trading desk swore it's gonna 10x from here, then yes, I'd strongly suggest rethinking that position immediately. Not because I possess magic timing powers, nobody consistently times tops, but because that entire decision process reveals speculation, pure and simple. On the flip side, if they're broadly diversified, genuinely understand markets cycle through manias and corrections, can sleep like a baby even if AI-related stocks crater sharply, then I'd tell them to focus far less energy on predicting the next 12 months and far more on building rock-solid long-term habits that compound wealth over 20 years.
And my complementary answer would follow immediately. Recognize clearly that we sit likely deep inside a bubble in key parts of the AI complex. Understand precisely what that implies for dramatically lower future returns and much higher volatility from those specific exposures. Then adjust your overall risk positioning accordingly, rather than falling into binary trap thinking. Heavily concentrated in the absolute most expensive AI names? Consider thoughtfully trimming and systematically reallocating into more balanced, lower volatility expressions, including areas of the market completely left behind by the AI craze. Meaningfully underexposed to genuine productivity-enhancing technologies altogether, consider adding some measured, properly sized exposure so you're not making an implicit bet against a genuine long-term structural shift. In other words, don't get anchored to the simplistic question, sell everything or stay fully invested. Anchor instead to how exactly do I position myself thoughtfully so I can comfortably live with either outcome, bubble continuation or bubble destruction.
At the end of the day, the market will do what markets always do. They swing wildly between irrational greed and paralyzing fear, fall passionately in love with shiny new ideas, then inevitably weigh every business on the cold, hard scale of actual operating results. AI will almost certainly change fundamentally how a huge chunk of white-collar knowledge work gets done, just as electricity transformed blue-collar manufacturing and computers transformed information processing. The real question facing every investor isn't whether the underlying technology proves real and powerful. The question is whether the price you're being asked to pay today leaves any genuine margin whatsoever for the inevitable surprises, setbacks, competitive responses, regulatory interventions, and execution stumbles that accompany literally every great innovation throughout history. If your clear-eyed answer is no, you don't need some elaborate, sophisticated theory or macro forecast. You just need the iron discipline to say out loud, "Fascinating story with real potential, but not at this price. Thank you very much."
And I'd close by emphasizing that economic cycles never prove accidents or anomalies. They represent baked-in features of how human psychology and complex systems inevitably respond to waves of opportunity followed by waves of fear. The current AI boom follows exactly the same arc as every major boom before it. Genuine technological innovation sparks real excitement. Overenthusiasm pushes every valuation metric into the stratosphere. Painful correction shakes out the weak hands and overpayers. And eventually, a more mature, profitable phase emerges where the real lasting productivity gains endure long after all the speculative excess gets purged. For serious investors, the true goal never involves perfectly surfing every single phase of that cycle. The goal centers on avoiding getting completely destroyed during the treacherous transitions. That means rigorously respecting all the objective bubble warning signs flashing red, remembering precisely how every previous mania ended, and building both a portfolio and a mindset that can comfortably handle both the spectacular bursting of the current AI bubble, whenever precisely that moment arrives, and all the genuine opportunities that absolutely still exist long after the headlines fade and the dust finally settles. History consistently rewards the prepared over the merely optimistic.
Let's make this concrete and personal, Ray. 5 years from now, in 2030, we sit down again right here. If AI stocks have crashed 60% peak to trough, while gold hits 10,000 an ounce, you win the debate fair and square. If those same stocks have steadily compounded at double digits while gold sits unchanged or lower, I win. $10 million to charity either way from each of us. Because what ultimately matters far more than who's proven right involves actually helping everyday people invest wisely, avoid disasters, and build real multi-generational wealth.
Agreed completely, Warren. And for everyone listening right here in December 2025, you face a genuine choice between two proven paths. Follow the concentrated bet on American business excellence and implicitly accept massive embedded currency and cycle risk. Or follow the diversified, systematic approach, protecting against multiple plausible scenarios drawn from 500 years of pattern recognition. Both cannot prove fully right. One strategy will preserve dramatically more wealth through whatever 2026 through 2030 delivers. Those December decisions you make in the next 6 months could literally shape your financial security for decades to come. Choose with eyes wide open.
My vote? Choose optimism, grounded in reality. Choose productive assets, creating genuine value. Choose America and her unmatched innovation engine. That's delivered the winning bet for 2 full centuries running. Nothing I've seen suggests that changes now.
My vote? Choose genuine preparation over blind hope. Choose thoughtful diversification across seasons. Choose respect for historical patterns that repeat relentlessly. Because every empire in history ignored those patterns at its peril. And we're not magically exceptional enough to constitute the single exception.
Time will tell who proves correct, Ray. Time always tells.
Indeed it will, Warren. Indeed, it will.